Well, good morning. Thank you very much for joining Samir and I while we talk through our results for the financial year to 31 March 2022. And I think just as an overlay, it was certainly a year of 3 quarters and 1 quarter. 3 quarters through to December 2022, markets were constructive. Central banks were dovish in terms of policy. And of course, that all changed come January. So as we moved into 2022, a lot changed. Markets sold off, small and mid caps sold off. The Ukraine was invaded, and the market outlook looked very, very different going forward. So just with that in context, POLR had a good year. It's increased in AUM by 6% over the year to 22.1 billion. It made strategic progress by attracting a new team, a sustainable thematic equity team. We launched their funds in October last year, and that brings with it additional £9 billion of capacity in Article 9 funds as defined by SFDR. Very good progress and continued flows into our emerging markets funds, £1.2 billion in AUM in those funds at the moment. So they drove the largest inflows into our funds. And of course, inflows over the full year were 391 million, of which 745 million came into segregated institutional mandates. So that implies actually at the top level, there were outflows from our open-ended UCITS funds. And I'll come back to flows later on. Strong balance sheet on the back of increase in core earnings. Increased AUM and core earnings allowed us to increase our dividend. I'll let Samir cover more of that a bit later on. And of course, we continue to focus on driving core profit going forward. In the year we've just had, we had a 35% increase in core earnings. However, that was offset by a reduction in performance fees, where we were coming off almost a record year the previous year. So total earnings actually declined, despite the fact that core earnings went up by 35%. Market perspective, again, I'm not going to go into detail. You all follow the markets very, very closely, but you can see those are the indices that affect us the most. And you can see what happened there as we approach the first quarter of 2022. The top line is the Dow Jones World Technology Index, which obviously went up the highest and came down the furthest in that quarter, obviously impacting our technology funds. Net flows across the industry, again, that's the Broadreach data. Net sales of funds across Europe, that's pan-Europe. You can see positive all the way through until January 2022, and then every asset class turned negative. And in particular, you can see equities negative in March and April and into May as well. Fund performance, and I'll touch on performance. That chart shows you all of our strategies since inception. The bars above the line indicate the outperformance relative to benchmark, and the bars below the line represent underperformance in those particular strategies against benchmark over that time period. Dark blue represents first quartile against the Lipper peer group, and light blue bars represent second quartile. So you can see there very, very strong performance across all of our funds. Only 5 behind benchmark since inception. Interestingly, 2 of those 5, whilst behind benchmark, are in the top quartile against the Lipper peer group. So that's European Income and Healthcare Blue Chip. But 100% of our AUM is in the top 2 quartiles since inception. Showing you the same data in a different way. What we're doing here is we're showing you the 3-year and 5-year, as well as the since inception data. You can see over 3 years, 84% is in the top 2 quartiles. Over 5 years, 93% in the top 2 quartiles. Against benchmark, again, since inception, impressive. More challenging for us in the shorter term. So our technology funds had a very, very tough 2021 calendar year, which obviously fed through into lower performance fee for our financial year ending now. But it's mixed. Technology struggled with performance. Healthcare had some funds performing very well, others not. But across the board, our value-oriented funds, very, very good performance during the year. One thing that POLR does focus on is capacity management. So it's important for us not to manage big volumes of AUM because that impacts on performance. Our belief is that volume destroys performance. So everything is capacity maintained. And what this chart shows you across all of our strategies is dark blue is what the AUM is at the end of March. Light blue is what the remaining capacity is. And we define capacity as that total AUM that we think the team can manage without negatively impacting on performance. So it's based on the ability to service the clients, underlying portfolio liquidity, portfolio turnover, and of course the market cap range in which you're investing in those companies. So if you're investing in much smaller cap or mid cap illiquid companies, your fund will have lower capacity. And that's the general sort of principle behind it. So you can see there is capacity in technology and healthcare. Insurance, which has been a really, really high performing fund. It's actually calendar year to date, it is actually up in absolute terms, despite the markets being down into bear market territory. Global insurance is actually up. Emerging markets, we've had good inflows. I'll come to that in a minute. That's got a good £4 billion of capacity and strong investor interest in that. And a bit further down that chart, sustainable thematic, you can see £9 billion of capacity. And whilst that team was only launched in October last year, we've had early traction and early flows into that fund. European income, again, a complete turnaround in performance during the course of last year. So really, really performing very, very well. As markets rotated from growth to value, they benefited from that. And we're seeing investor interest in coming into that as well. In terms of flows, you can see we've grown average AUM. This is to the end of March. We've grown average AUM by 23% compound over that 5-year period. But the markets have sold off. So since end of March 2022, since our year end, in the current quarter, markets have continued to sell off. And as at the end of May, our AUM had declined from 22.1 down to 19.99 billion. So giving back some of that increase last year. Over the 12 months, that shows you the flows. Left-hand side of that chart will show you the net inflows. So that's net inflows into the strategies. So you can see the largest net inflows over the year were emerging markets, then healthcare, financials, convertibles, the new smart funds. So those are the sustainable thematic funds, smart energy and smart mobility. UK value, we had good inflows, and of course Japan has come back into its own with good performance, but also investor interest coming into that. As we move right, you can see we had some that were in negative territory in terms of flows, but of course the big one for us was as technology stocks were sold off during this period, the latter half of our financial year, we suffered outflows. Now, these were not clients redeeming entirely. What these these are UK intermediary clients and European intermediary clients reducing their weightings to growth stocks, reducing their weightings to technology. So we could see our clients reducing their weightings, coming out of the growthier parts of the market and going into other parts of the market. For example, financials, again, possibly commodities and other more value-driven areas. Just to put the outflows for technology into perspective, net outflows in the year 1.3 billion. That compares to net inflows in the previous financial year of 1.8 billion into technology. So you can see as COVID hit, we had this fantastic demand and inflow into our technology funds. As we came through COVID and as we came into sort of returning to normality and growth stocks and tech stocks sold off, we saw the outflows come in. So a net 0.5 in over the 2-year period. I think it's important to remember that number. So that's a big number. $500 million net inflow into tech over the 2-year period we're talking about. That chart there just shows you the cumulative net flows that we've had since April 21. Top is showing X technology and the bottom one shows all of it. So you can see how technology overshadows what other parts of our group we're seeing some really good inflow traction on. In a different way, this is just showing you the flows in the last quarter. So this is the quarter where the markets really, really did turn and they went bearish. Right-hand chart is everything excluding tech. So you can see a very, very good quarter for emerging markets, financials, insurance, smart funds, convertibles, European income, and Japan, and not so good for Continental European Opportunities Fund, the Melchior Fund, UK Value. So UK Value Fund is a small mid-cap focused fund. So we suffered from sentiment turning against UK small mid-cap companies. North American and of course healthcare, we saw some clients reducing their weighting to the growthier parts of healthcare. On that note, I'm going to ask Samir to run through the financial aspects of our year. Thank you, Samir.
Thank you, Gavin. Good morning, everyone. So the next few slides take a look at the P&L profile of the company and also the balance sheet, and we'll round off with just a brief discussion on the dividend policy for the company. Now, as Gavin alluded to earlier, the story of the financial year really has been a story of the first three quarters and then the pain coming through the last quarter. The first three quarters, strong markets, good flow momentum, really driving the increase in average AUM year on year, which is right at the top of that highlight slide. Average AUM up 37%. That has fed directly into the net management fee line of revenue being up 31%, and ultimately feeding into the first leg of our profitability, what we call core operating profits, being up 35%. I'll just take a little bit of time explaining what I sort of put forward as the three legs of profitability to understand how our P&L works. Really, the first line that we call core operating profits is really the net management fees less the direct and allocated costs of running the teams at the business, provide a metric of core operating profits. And as you can see, directly linked to the average AUM going up, core profitability has gone up 35% year on year. Core operating profit margin has moved up 1 percentage point from 36 to 37%. And what that points to is really as the business has grown and as the cost base has grown, that has been managed with a view to investing back into future growth of the business, but also sensibly managed so that actually the core operating profit margin is growing. The second leg of profitability is performance fee profits. We are a profit sharing model in terms of how we're set up as a business, and therefore an element of the performance fees profits that the business generates is paid out to the teams that manage the funds. And the net of those two is what we call performance fee profits. And again, year on year, we've seen a drop in performance fee profits, which has resulted in overall profits decreasing. Last year was a near record year for performance fees for POLR, and this year was therefore always going to be more challenging to return a number similar to last year, and obviously the 4.1 million coming in this year, given market conditions, is a big drop. The third and final line in terms of profitability is other income. The best way to think about other income is we do have a seed portfolio, which I'll touch on in a little bit, and that is really to grow nascent and invest in nascent products that the company launch. And the other income line represents the P&L, the mark-to-market P&L on those seed investments, but also the hedges that we take out to preserve investor capital. So the net of all of that goes through the other income line and broadly moves in line with how well we're doing in terms of performance fee profit. So as you can see, last year we had good returns of both those lines, and this year lower numbers. Pulling all of those things together, adjusted diluted EPS, total EPS for the year came in at 56p, which is down roughly 10%, predominantly driven, as Gavin and I have just explained, by lower performance fee profits coming through. Total dividends at 46p for the year are up 15% year on year. And really that is a function of the second interim dividend moving from 31p last year to 32p. And that increase is a reflection of core operating profits moving up 35% for the business overall, and the management team and the board feeling that some of that absolutely must be passed on to investors. as those numbers have been returned in the financial year. And then the small increase in the second interim dividend from 31 to 32p, as I mentioned, is just really a small signal of the confidence in the fact that the fundamentals of the business have not changed, regardless of the short-term turmoil that the markets are going through, and just gives a nod to our confidence in the medium to longer-term prospects of the business. I'll spend a little bit of time talking about operating costs, because obviously year on year these have increased, but really the chart on the right paints a good picture in explaining that actually the increase is driven by variable staff compensation costs and also exceptional items appearing on the book year on year. In terms of thinking about variable staff compensation costs, as I alluded to earlier, we are a profit share model in terms of the business model. So therefore, out of the profits generated, the teams access some of that profitability, and some of that year on year increase is a result of core operating profits increasing, and therefore some of the core distributions payable to the teams increasing. But also the other thing to remember when looking at this slide is actually thinking about 2021. We had 2 teams join as a result of acquisitions that we've done over the last 18 to 24 months. And really in 2021, that column only includes 1 month's worth of cost for the Dalton team, or the teams that came over from the Dalton acquisition, because that completed in February last year, and only half a year's worth of cost for the Phaetian team, which again, depending on the completion there, only had that amount of staff costs coming through. Roll over to the 2022 column, there are 12 months, full 12 months of cost for both those 2 teams, and also an additional 6 months worth of cost for the new sustainable thematic team that arrived in September this year for this financial year. So that also explains a big chunk of the increase year on year. And as I mentioned, cost discipline in managing the cost base of the business is demonstrated by really the core operating profit margin increasing by that 1 percentage point that I alluded to earlier. We'll look at operating and other operating and exceptional costs next, very, very briefly. The couple of messages there are really that non-staff related other operating costs of the business are actually quite lean in the grand scheme of things. They have gone up slightly, but again, the message there is they've gone up in proportion to, again, those teams arriving in depending on when they arrived. So we're carrying a full 12 months complement of things like IT infrastructure and professional services fees related to, again, things like the sustainability team joining halfway through this year, launching 2 new products and setting up a regulated Swiss entity for them this year. The other line to note is travel and entertainment. We've done more travel this year, as you would expect, with restrictions easing. Another thing to note is that cost there for this year is roughly about 60% of what we would have done in a pre-pandemic environment. I don't expect us to ever move back to 100% spend, because given the way we have all learned to work remotely, I expect travel to sort of stay below that marker pre-pandemic. Exceptionals, again, the message there is there are large numbers going through the P&L, but a lot of these are non-cash. They are wholly acquisition related. So again, the Dalton acquisition completing towards the end of last financial year meant that a good chunk of the reorganization costs fell into the financial FY22 financial year, which we flagged at the time of completion, and you can see that 3 odd million coming through this year. The remainder of the costs are really non-cash costs, amortization of intangibles, which again, going forwards, we expect some of that cost to still appear as the Dalton intangible carries on unwinding over the life of that intangible, according to accounting conventions. And then another chunk of those costs come through from the closure of the Phaetian mutual funds in May 22, and as a post-balance sheet adjusting event, for the sake of prudence, we have unwound the related intangible and the liability related to those assets. So again, the message there is acquisition-related exceptionals make a chunk of the increase in total costs, and these are expected for a large extent to be non-recurring. Moving on to the balance sheet, the cash and seed profile demonstrate good, strong strength on the balance sheet. We continue to support 8 funds, and again, the change year on year is the fact that we have seeded and we are supporting the smart energy and smart mobility funds for the new sustainable thematic team that arrived halfway through this year. A reminder, in these times of volatility, we do seek to hedge for market and currency movements as best as we can on that seed portfolio as we look to try and manage the group's capital. And talking about that, moving over to a view of capital, looking at the table on the right, the message is that roughly 70 odd million of surplus capital above regulatory capital requirements. So a good, comfortable position. And the bars on the left demonstrate that actually year on year, the way we allocate capital across the business hasn't really changed. And the graphic at the bottom of that left-hand side really shows that the framework for use of capital and how we think about it, again, hasn't really changed. We will continue to use capital to seed new product ideas or team extensions through the seed portfolio. We will look to return capital to investors through our ordinary dividends, which is our main avenue of returning capital. There is a small share buyback program that works in the background to dilute the impact of share incentive schemes. And again, we will continue to maintain some balance sheet strength for difficult times as we're experiencing now and for future growth of the business. To round off, I'll spend a little bit of time talking about the dividend policy and how the management team and board have thought about the dividend for this year. A reminder that for any given year, our total annual dividend is expected to fall within a range of 55 to 85% of adjusted total earnings. And that broad range is really there whilst recognizing that we do have performance fee profits as part of our P&L and profitability mix, and those can be variable. And that range allows us to sustainably grow the dividend over time rather than being beholden to a very fixed progressive policy. And you can see that despite not having a progressive policy, we've grown dividend over the last 4 years at a compound annual rate of roughly 12%. Given this year's smaller performance fee contribution, this year's payout falls within the stated range. It is 82% on the adjusted total earnings for this year, and it is a 15% increase year on year to 46p. And as we look forward again, there is short-term volatility in markets and pressure on earnings. And the message really is that we do look to use that balance sheet strength to support that dividend if need be. I would point to those of us who are new to POLR and looking at us for the first time possibly, that actually in 2016 and 17, when we did go through similar a period of stress, that actually we did pay an uncovered dividend, and we did use some of that balance sheet strength to underpin the dividend. So again, very much as we've thought about the stresses and the short-term pressures, we feel really comfortable that actually our balance sheet is actually stronger than it was back in 16 and 17, and if need be, there is a good underpin to the dividend. The one final number that I will leave you with, someone recently on the roadshow asked how we thought about sort of stress testing, and the one thing I'd leave you with is each p of dividend is roughly a £1 million outlay in terms of cash to the business. It's slightly lower, but good round numbers to think about. And therefore, as you think about projections and earnings for next year, you can see that with the strength of the balance sheet, even if we were to sort of end up having to cover, as for an example, in 2017, we probably had 5 odd p of an uncovered dividend, the uncovered portion. You can see that the balance sheet strength, how that really compares to those sorts of numbers. With that, I will pause. There will be opportunity for questions later on, but I will hand back over to Gavin to run through the remainder of the strategy.
Thank you, Samir. moving on then back to strategy, which is really growing with diversification, which is important. That's to try and reduce that concentration on technology, to a lesser extent healthcare, sort of the two big franchises. What this chart does here is it shows you that 3 of our largest 6 strategies by AUM, that is, have been launched in the last 5 years. So UK value, European opportunities, and emerging markets have all arrived in the last 5 years, and they now make up 3 of our largest 6. So you can see progress in the right direction in terms of building a more diverse range of strategies at POLR and getting contributions from more of them. So we're quite pleased with that progress. And of course, strong flows into the emerging markets funds means that's going to increase. That 1 year percentage AUM growth of 160% in emerging markets is encouraging. Again, so the idea of moving more into institutional seg mandates, the segregated mandate market, you can see we've made progress there. 745 million pounds of new mandates during the course of the year, and that now makes up 5% of our total AUM. So just really diversifying into that institutional channel as well. Likewise, diversification regionally with our client base. You can see, and this is in the last 3 years, so 2019 compared to 2022, you can see the Nordics has gone from 0 to over 400 million of client AUM. And Asia has seen significant growth. So you can see it growing to just under 1.4 billion of client AUM. Overall, across the group, 9 billion of our year-end AUM is now non-UK. So you can see it's diversified very, very well regionally across the market. And of course, the Nordic distribution was very, very important for us because that supported the emerging market flows. And more recently, it's supporting the smart energy team flows. US, we are planning to build a significant US business over time. We've developed a well respected team, both East Coast, Midwest, and West Coast, 3 individuals, sell cross-channel, done very, very well. Selling emerging markets mainly in our 48 mutual fund range. That's their key focus and getting interest. Unfortunately, a hiccup with Phaetian, and I have seen the chat, there's a question on that. Phaetian we brought to a close fairly early on because we saw warning signals. That transaction, that team acquisition was completed in lockdown. And very, very soon after completion, we realized that the actual structure, modus operandi of the team was fundamentally different to what it had been prior to the pandemic. And it was just not going to work going forward. So we had to do something. And the result of it is the fund board elected to actually suspend the funds and close them down in the best interests of the fund investors. And we are effectively winding down the Phaetian partnership with our partners in the US. And we actively look for new teams in the US. And so there are conversations ongoing. When we realized that the Phaetian concept was not going to work, we started looking for alternative teams in the US, and those have progressed very, very well. And of course, we've learned very, very good lessons through that whole process. One is you do need to spend lots of time in person, face to face, really understanding the culture, the motivations of teams and people in our industry. And we just didn't have the opportunity to do that given where we were with the pandemic. ESG, I won't dwell too much on this, other than to say 13 of our 25 funds are now Article 8 or 9, and increasingly more of our funds will be moving from Article 6 to Article 8. The 2 Article 9 funds are the smart energy and smart mobility. So they are making a positive impact in terms of what they do. We've continued with our corporate social responsibility program. That's a bursary program for inner London City School, supporting laptop program for their sixth form students. And of course, we continue to measure our carbon footprint in support of the Paris Agreement. So no change to strategy. It's growth with diversification, very much focused on growth. We continually search for new teams, so that is ongoing. Regional distribution diversification, again, ongoing. So more into Asia, the Nordics, Europe, and North America. But of course, we have significant remaining capacity. I think two things that give us confidence now, even despite the market backdrop, is we have significant capacity across our existing teams, 40 billion pounds of capacity, and we've got a very strong balance sheet. So those two factors do give us confidence going forward. So finally, in summation, and very happy to respond to questions, is the outlook is positive from our point of view. Strong balance sheet. Teams launched in the last 5 years make up 3 of our 6 largest now, so you can see that diversification coming through quite nicely. Flow momentum continues into emerging markets. The rate of outflow from technology has slowed. So the Q1 of 2022 was the largest month of outflow. Almost half of their total annual outflows were in that quarter, and that rate of outflow has slowed down. We're still seeing outflows, but it has slowed down. And of course, continued focus on driving core earnings for Polar Capital. So it's all about driving core earnings so that can support a growing dividend over time. And significant capacity across differentiated products, which enables us to diversify that distribution channel. So thank you. That gives you a sort of an overview of where we are at Polar, and very happy to respond to questions. I think, Hannah, you moderating.
Absolutely. Well, thank you both for that presentation. Let's start with a question on your tech fund. Has it seen more outflows than your competitors?
It's very, very difficult to tell. I mean, I think outflows have come out of growthier global funds, not just tech funds. It's quite difficult to get that information. What we're finding is our tech fund is probably not the most aggressive. So you'll find they've probably outperformed the more aggressive technology funds and probably underperformed the more conservative ones in this current market environment. So that they're performing exactly as we'd expect them to perform. I think the key thing to say is, while we can't actually compare flows between our funds and others, is 2.7 billion of the total tech AUM is a technology trust. So that's fixed capital. So the outflows really relate to 2 funds. One is the automation and artificial intelligence fund, which is the smaller of the 2, and the other one is the open-ended UCITS fund. Performance, they're in the middle of the pack. So they're in the second quartile. So again, as you'd expect, middle of the pack.
And that reduction of weighting process, do you think that is largely over? You've seen that slowing considerably?
Yeah, I mean, again, sort of, I suppose, anecdotal evidence. We're now having clients who have reduced their weightings. So these are long-standing clients of ours. We see them as they go through cycles. They've reduced their weightings to growth and tech. And they're now coming back and having conversations with the team and our client servicing people, saying, is it not now time to go back into tech? Have valuations come down sufficiently to make tech investable again, particularly in that sort of smaller mid-cap tech company, where the companies have really had a significant derating? Are they now at fair value? So our clients are now sort of saying, well, actually, we should be thinking about coming back into tech. Now, that hasn't yet translated into flows and allocations back into tech, but you can see the direction of travel. You can see the mindset. I mean, tech has come off a lot. I mean, NASDAQ is down over 30%. The S&P is down 20% calendar year to date. So you can see there's been a massive, massive derating.
You mentioned there in your answer that people were looking at small and mid-cap. But there's a question here. Is there any evidence that the dominance of the mega cap tech is coming to an end? And do you see anything apart from potential regulation that could cause that?
And again, this is probably above my pay grade. Better to ask Ben Rogoff or the team themselves. But I think there is evidence. I mean, I think the growth of the mega caps, that's hurt our performance. There's no doubt, because we would typically be underweight those mega caps. So being underweight Apple, being underweight Microsoft has hurt them. And I think the team would tell you they believe that dominance will come to an end at some point. It always does. If you look through history, you'll see those big mega cap dominating companies eventually don't continue to grow at the same rate. So the rates of growth come down, and they are. And we've started seeing that in some of the very, very large capitalized companies. They've come off. So yes, there is anecdotal evidence, but let's wait and see. I think people still now flight to, they prefer in volatile times to have more liquid stocks, and those mega caps give them liquidity, whereas the small mid caps don't. So they will go to the less riskier part of tech, which means mega cap. But that'll change over time.
Okay, look at a couple of different funds. Asian stars and EM stars have underperformed, I beg your pardon, a lot over the last year. What are the reasons for it, and is it starting to impact flows?
Right. So firstly, to answer the second part of the question first, it hasn't impacted flows because the investors have followed this team for a long time. They know they've got a 7-8 year track record, and they've been through this before. So we don't see any impact on flows at this stage. It is really just the very short-term performance that's been impacted. If you look at their 3-year performance, it's very, very good over the 3 years. Why has their performance been impacted? They are core to their strategy is sustainable investing. So they will typically always be underweight resource commodity countries. So the best performing emerging market would have been Latin America over the last 6 months. They were underweight and very far underweight. So that would have hurt them on a relative basis. They weren't hurt at all by Russia. So they had 2 very, very small holdings in Russia, which they exited before sanctions hit. So that didn't impact them. And the reason they were underweight Russia is obviously from a sustainable investing, from an ESG perspective. They just couldn't get their minds around holding big holdings in Russian companies. And of course, the other one is they tend to always be overweight China. So, the China stocks have seen a big sell-off. I mean, the prolonged zero tolerance policy on COVID in China has affected them. So it's underweight commodities and energy. It's overweight China. And that's probably the main reason why they have underperformed over that period of time. And of course, emerging markets has been a very, very tough area, and in particular, again, for that sort of mid-cap company range.
You touched already on the Phoenician situation in the US and mentioned that you're already talking to a number of other teams. Are you happy to sort of give an indication of how long you think those discussions might take and whether we might see anything in the next 6 to 12 months?
Difficult to tell. These discussions have to take as long as they need to take for us to get comfortable. Bearing in mind, we have learned lessons. For me personally, it's the first mishap I've had probably in 20 years with the team. Very, very extraordinary circumstances, and we don't want to make a mistake again. So conversations are in place. I think one comment I will make is in periods of market volatility and times like this, it can be slightly easier to attract teams because good fund managers are thinking about their careers. Possibly their retention equity has not got the same value as it might have had a year ago. So you can have those conversations. So certainly my experience is back in 09, 010, following the financial crisis, that was a really, really good time to find displaced, fantastically talented managers. And we're seeing a similar thing now. So as we're reaching out now, we're not having a problem at all initiating conversations. But the time it takes to have an initial conversation to actually getting the team in, that's anybody's guess.
Thank you. Perhaps a couple of questions now sort of around dividends and ownership. One gentleman asks, is it safe in the near term, the dividend itself? Perhaps you just want to reiterate some of the messages there around how you allocate and the progressive nature.
Sure, Hannah, why don't I start and Gavin can chip in. But just to repeat some of the messages, we as a management team and as a board have really good confidence in the fundamentals of the business. And if we think about just the pure near term, the message is really we have not shied away in the past from using some of the balance sheet strength to underpin the dividend in times of stress. And the sort of numbers that I mentioned in terms of stress testing, that each P of dividend is roughly £1 million in terms of cash outlay to the company. And if you look at the balance sheet strength slide in terms of how much cash we're carrying, we're actually carrying much more than what we were in 2016-17, the last time we paid an uncovered dividend. So again, there are lots of moving parts here, but I think in the near term, the financials of the company are sound, and we approach the near term with confidence.
Thank you. Another question here is around ownership from the management team. This gentleman points out that the MD of Saga has directed his board to personally purchase and continue to purchase shares in the business as a way to, I suppose, show ongoing commitment from the board towards the company's success. Has POLR considered schemes in a similar vein?
Well, I think we do have a long-term incentive plan for executive directors. So Samir and I are both executive directors on the board, and we do participate in an incentive plan that they have performance hurdles placed on them. So we've got to meet performance targets which are set for shareholders, so they get returns. So that's there. There's no plan for a formal policy on non-executive directors, but non-executive directors, including our chairman, do own POLR equity. But we haven't put a formal policy in place to sort of say how much they should own or what percentage of their directors' fees, or whatever the case is. There is a formal policy around the executive directors and the executive committee share ownership. That's very definitely there.
Well, thank you both. That is it from the questions for today. So a helpful update, and we look forward to seeing you again in 6 months' time.
Thank you all very, very much for listening. Thank you.
Thank you very much, everyone. Thank you for your support.